everybody. I'd like to pick up at the very beginning with something that Larry had said at the beginning of his presentation about science working very hard on the biology of the SARS-CoV-2 virus and not necessarily having any results, but at least science is working hard on it. My piece in the Journal of Structured Finance that was featured, and I guess why I'm here talking to you, at least in part, was about how academic finance has been clinging to ideas that were novel a century ago but indefensible today. The thought leaders in finance are people like my esteemed colleagues here, but they come from the market. When the last four crises happened, and my comments don't necessarily tie with my bullet points, but they're the same ideas, so please bear with me. When the last four crises happened, I was directly professionally involved in each one of them. I sometimes feel like Chauncey Gardner in being there. So I graduated from the University of Chicago and went to work at Continental Bank at the time that it was declared too big to fail. I then went to work on the floor of the Chicago Board of Trade because it was closer to what I'd learned at Chicago. And I was there the day that the markets went limit down on Black Monday in 1987. I was working for Moody's in Asia, rating Asian structured and project debt during the Asian crisis. I left Moody's because I had discovered a problem with structured ratings and I wanted to solve the problem, namely the secondary market. And that solution was directly related to the global financial crisis. That, you know, our solution together with my experience has provided a lot of the work that we've done since the GFC. As it happens, I was in Hong Kong and in Beijing during SARS, and that was when I recognized something in the news about the way the case fatality rate was being mismanaged that looked strangely familiar, and that's really one of the points I want to make today. And finally, I have no particular insights into SARS-CoV-2, but I am a small business dealing with the shutting down of the economies, and I'm feeling the impact. So overall, what I want to say is that these events, they all happened after Eugene Fama and Merton Miller published The Theory of Finance. These were crises that happened after the book on the so-called theory of finance was published, and I see the fact that crises continue to recur as a kind of referendum on the poverty of academic finance, especially the last three. The Asian financial crisis to some extent, but also the global financial crisis, some problems that arose in SARS, and the problem today. I believe as a securitization expert that these all have a common root, and the root is as follows. We've lost the connection to moneyness or to money value in the securities market. It's closer in the bond market than it is in the credit market because, well, I'm a securitization expert, so for me, equities are simply residual value. There's a close connection between assets and debt, working capital, short-term, long-term, that is intrinsic to the life of the company. But because we've lost the connection to moneyness, it's only in crises like these that we're forced to start looking for money. Lawrence was talking about, you know, stay liquid. We're forced to look for money, and that need amplifies the crisis. So what is moneyness? Let's go back to the definition of money for an answer. People have their favorite definitions. There are three sort of standard ones: exchange value, store of value, and unit of account. But for money to be money, all three need to be operative. So if we look at the moneyness in securities, we need to also look at exchange value, store of value, and unit of account, or let's say a measure. So the theory of finance says that price is the money, but let's not forget some facts. Company finance went off the balance sheet in the 1980s with securitization. And then three decades later, the GFC happened. So price was not enough in that case. And after the GFC, a lot of people diverted into buying hard assets, but they're pretty illiquid right now. So that looks like a suboptimal decision. And I suggest that if we look really deeply, the rise of crypto is connected to the search for moneyness or the loss of connection to money. Money, the money that we use, the government money, is not enough in some sense. Also, if we think about what happened beginning in the 90s, company operations began going off the balance sheet as well. When you look at the balance sheet of Ford or any of the large institutions whose, well, I don't know, because Ford is now, not investment grade by both Moody's and S&P, but in any event, the large names that give us comfort, we don't really know where their money comes from because the internal economy is so distributed. The supply chain simply, there's no reckoning of it in the balance sheet. So 3 decades later, this virus is exposing us to a supply chain crisis with both supply and demand side implications. So all of these trends to me signify the need to do a better job of following the money. So what is it that we're specifically doing wrong? Well, I would suggest that we're counting money the wrong way. And let me give you an example, one that should sort of come close to home. If you search the keyword corona on the Worldometer's info website, which is a good website, you will find that today there are 803,187 cases of COVID-19. Of those 800,000 odd, 211,000, or about over 30%, have been resolved one way or another, either through recovery or through death. Now, there is one school of thought that says that the way that you report a mortality rate is to take the current death rate and divide it by the total population. And this is what happened when SARS came in 2003 as well. One teaching hospital in Hong Kong, who was in charge of reporting numbers, did just that, and they offered a 4% mortality rate. Another teaching hospital offered a 10% mortality rate. The global average is actually 10 to 11%. The difference is that when you actually compute a case fatality rate, you need to look at a static pool. You don't want to look at the entire population of people who have had or who have the entire infection rate. You want to look at the total number of people who have either survived or not survived the disease, and the ratio is of the two, the dead versus the total, is the right number to use. And the differences are significant. So in the case of SARS, it was 4% versus 10%. Today, the mortality rate is much higher. It's disturbing. And it's not really difficult to forecast case fatality rates correctly using a relatively small sample. It may not be the final number, but it's a good starting point. The reason why, it's not clear to me whether the reason why we don't use the right ratio is because of fear of what will happen if you have the right information, or whether it's because of a lack of knowledge about how to compute it. But what I want to say is that the exact same counting problem arose and was at the root of the GFC. The failure to look at loan defaults based on the population of loans in portfolio using a much larger denominator actually gave rise to the GFC. This is really just the Monty Hall problem repackaged. If you believe that the information doesn't matter, then you think that every time you open a door, the odds are 50-50 that you'll win or lose. But actually, you need to look at the conditional probability. This is true for the Monty Hall problem, and it's true for credit, and it's also true with our lives. So this recommendation to begin to count the moneyness in the securities, in certain securities, the ones that are backed by loans, like in securitization, only really works for the securitization market. But the failure to do that was a game changer in a bad way a decade ago, and it could become a game changer once again, because if you actually look at the performance of loans in a robust way, you can find that some of the capital placed against those exposures is redundant and could be freed up. So that's a longer conversation, but approximately 33% of the capital that's placed against non-existent risk is being wasted right now. And that's free cash that could really be used at the moment when governments have shut down the economy. So what can we do about the moneyness problem? We can start counting risk the right way, looking at conditional probability. We can require our authorities who may be declaring the wrong statistics to start counting risk the right way. And we should consider replacing some of the authorities, for example, credit rating agencies, with some standards so that we can do the counting ourselves.
So we have a question for you, Ann. Can you say a few words about why academic finance evolves so slowly?
Well, that's a really deep question. And I have my theories, but I'm not sure how authoritative they are. I think one of the factors has to do with the way academics work and the fact that the subject matter is about money. It's not, the expertise is not about a domain where money is the source of funding for exploration and research. Money is the topic. So I think that academic finance isn't alone in evolving slowly. I think that, and if you read the paper talks about the Thomas Kuhn, structure of scientific revolutions problem, that once a canon is created, it's very difficult for the experts to back away from what they said was true and allow new ideas to come in. In that sense, it's not unique to finance, but what is particularly challenging for finance is that at the end of the day, we all look at money. And as long as we have money in our hands, we say, well, we're doing pretty well. But what we're not actually doing is we're not motivated to look at the theories behind it and to count the opportunity cost of what we may be getting wrong. It's only in crises like this that we're allowed to actually, or encouraged to, or motivated to look at what's going wrong. I would add, Mark, you know this, so Mark is a very open-minded editor who's genuinely interested in the competition of ideas, but the paper that I published in 2018, the embryo, that was a paper that I was asked to write in 2009 by my university, and then they decided that they didn't really want it out there because it didn't go along with what the Academy said. There is censorship, but this is not unique to finance. It's just that money is at the center in finance, I think. Okay.
So actually, Ann, you've given me a great segue here. I want to remind everyone that the subjects that the speakers are talking about are also covered in varying degrees in their papers, which are included in the collections that we've put together in flip books that you've received links to. So Larry's paper is in the second flip book in the Financial Crisis series on page 49, and Ann's paper that she's been referring to is in the third flip book on page 16.